Hey there, folks. Welcome back to DailyCrest, the channel where we break down the latest news and developments that impact our economy and our lives. I'm Mercy, your host, and today we're diving into the world of finance and policy. We've got some freshly released information that's been making waves, so let's jump right into it. All right, everyone, so here's the deal. We're talking about the Federal Reserve, the big players in our nation's monetary policy. They had a meeting on July 26th, and boy, oh boy, did they make some moves. They raised interest rates, and it seems like they're keeping a close eye on inflation. You know, that pesky thing that affects the prices of everything from your morning coffee to the cost of housing. Now, inflation has been a hot topic recently. Prices have been cooling down a bit, but don't get too comfortable. The Fed's meeting minutes show that they're still concerned about inflation's lasting power. They might not have thrown a victory party just yet, but they did acknowledge a slowdown in inflation. However, they emphasized that it's still unacceptably high. That's right, folks, the Fed isn't popping the champagne just yet. So guess what? The Fed decided to crank up those interest rates at the July meeting. It's the highest they've been since 2001. Why are they doing this? Well, they've been gradually increasing rates over the past 17 months to put the brakes on the economy. They want to make borrowing money a bit more expensive, hoping that people will spend less and cool off the demand that's been driving up prices. Here's the twist, though. With inflation easing and interest rates climbing, investors are scratching their heads. Are the policymakers going to keep hiking up the borrowing costs? Inflation dropped to 3.2% in July from a whopping 9% back in mid-2022. That's quite a dip. But of course, the Fed isn't ready to back down just yet. It's a classic case of economists not quite seeing eye to eye. Some officials at the Fed meeting were all for raising those rates in July, while others were a bit more cautious. A couple of them even said, "Hold up, let's not raise rates just yet." But most of the gang was on board, and they're hinting that there could be more adjustments down the road. The Fed has a lot to juggle. The economy is like a tricky balancing act for them. On one hand, the job market might be cooling down a bit, but consumer spending is still going strong. Unemployment is low, wages are growing, and companies might just feel confident enough to start charging us more for their products and services. The good old uncertainty factor. Financial conditions are tight, making borrowing a bit of a headache. But on the bright side, the housing market seems to be steadying itself. And the Fed's staff economists? Well, they're rethinking their earlier prediction of a mild recession. The economy's resilience has them changing their tune. Now, here's where things get tricky. Predicting the future of inflation isn't exactly a walk in the park. There are so many moving pieces. Cheaper gas might have helped bring those price hikes down. But wait, gas costs are creeping back up. On top of that, rental costs are easing, which should help keep those overall numbers in check. And China's slower growth, yep, that could put the brakes on global commodity prices and slow down inflation in the US. Oh, and let's not forget about the Fed's shrinking balance sheet. They've been slimming down their bond holdings, which can impact asset prices. Even as they're planning to bring interest rates down next year, it looks like they're committed to continuing this process. All right, folks, there you have it. The Fed's been making some moves, keeping a close eye on inflation and juggling all sorts of economic factors. Remember, it's a delicate dance they're doing to keep our economy in check. Stay tuned to DailyCrest for more insights into the world of finance, policy, and everything in between. I'm Mercy, signing off.